Two items, Collins. We will be in the middle. I will be just if things go too complicated, I'll just try to kind of uh, not willingly, but will try to interrupt you just for a second and kind of simplify it because not everybody is as smart as you, including myself. I'm not as smart as you right now in your particular topic, right? So we just want to make sure um, while you're going through this, just want to ensure that all of our audience can understand. Like I said, this is more of a webinar where people want to watch it in their later time, and they may not have an opportunity to ask you questions right now. And that is one of the reasons why I want to make sure when we're going through this, uh, within 30 to 40 minutes or 30 minutes or less, we want to give the core of the concept here and let them ask any questions. But in between, I may ask you a few questions, and afterwards, I may ask you some of the summary type questions.
Uh,
So without any
please,
further delay,
I know it can be a little technical, so yeah, please feel free to interject, Sid. I'm happy to answer yours or any other questions that
yeah,
may come up, and I'll try to you know put everything at a level that can be
yeah.
understood. So
All right, cool. So without any further delay, good afternoon, everybody. It's 12 o'clock, lunch hour on Wednesday. We bring this webinar podcast. We have done combination of things. The goal is to keep our audience and our fellow um, partners educated as much as we can. Today we've got Collins. Collins Taylor is an expert in several areas, especially self-directed IRA and IRA certified professional. Um, I just wanted to ensure that anything that we're discussing here is not an advice in any way or not a financial investment advice. It's just an education purpose. So before you take any action, obviously consult your attorneys or your financial advisor or whoever you trust. But today's the goal is to share what we know and how we can help each other um, building our legacy, right? So this is our legacy webinar or building legacy webinar, and today's topic is self-directed IRA. Collins, over to you.
okay, thank you, Sid. I appreciate it, and yeah, to your point, I am a certified IRA services professional here within Inspira. I work with a lot of our investors as well as our team internally on the business development sides. In particular, I do a lot of collaboration with investment sponsors, people who are raising money and helping individuals to invest into real estate. That's the biggest part of my job, and I think the most fulfilling as well. So aside from the educational piece that I get to share with people, so um, I will also just give a brief disclaimer to kind of hit the nail on the head.
Yeah,
This is, like Sid said, it's purely for educational purposes, right? I'm not an attorney, a tax advisor, CPA, but I do want to be able to impart, some of the knowledge that I have on these IRA accounts and how you can utilize retirement capital to invest into the real estate market, in whatever way makes the most sense for you. So, this is not, any sort of investment tax or legal advice. It is purely educational, so take it as such. But I would be more than happy to answer any questions and help um with guidance in any way that I can professionally. So with that being said, I'll just give you kind of a brief background about myself and what qualifies me to talk on this subject. So I was born and raised in Houston. Actually, my parents were real estate investors themselves, so I had some exposure to this industry at a pretty young age. were initially doing when they very first started, they were doing fix and flips on single family homes, and have done some other real estate asset classes and different strategies. They're currently and things that they've done with their IRAs have been with sorry, not multifamily, uh mobile home parks. I don't know why I couldn't find the word, but they've invested in mobile homes. It's something that they found a lot of success in. And yeah,
Multifamily came in because your host is multifamily. That's why.
yeah, yeah, exactly. But they've invested in some other things. They've done multifamily investments. I've done some multifamily investments myself, and yeah, it's very powerful. The what the real estate market can do for your investment portfolio and diversification, and some of these other factors that we consider so important. But that is a little bit about my early years of exposure to real estate investing. So fast forward a little bit, I attended Texas A&M University, where I graduated with my degree in agricultural economics, and did a focus in finance and real estate out of that. And then also I had a minor in financial planning. So initially out of school, and for several years, I was working as a certified financial planner with some small RIA groups that are local here in Houston. Working with high net worth families and individuals and people that are, looking for tax strategy and portfolio management, estate planning, risk mitigation, all these different things that we did. So got a lot of exposure, especially to the public markets through that, and eventually had an opportunity to transition to the private side of the investment industry, and that's kind of how I made my way here. But I've been with Inspira now for several years, and in the self directed space now for six or more. So. Um, that's a little bit about me. I do a lot of education now within the company, teaching investors how this is an option, what their choices are, and the process to actually do it. So that's what we'll talk about a little bit today.
Alan's quick
Um,
question. So, Inspira, your company, um, you guys strategize or particularly focus into IRA, or you provide other services as well?
we do provide a plethora of other services. It's not just retirement accounts, and it's not just IRAs. We hold some 401k plans. We also do like corporate health plans, flexible
But
spending accounts, and HSAs.
in terms of the real estate investors, the self-directed IRA is what you specialize in, right?
Yeah, that and 1031 exchanges we handle as well.
Okay, cool, very cool. What just to ensure everybody understand what Collins can help you guys with, if you have a 1031 exchange, he can be a custodian and he can help you with the transition. If you have an IRA that is invested into market and you want to keep it, that's awesome. But if you have other plans to invest that money into real estate or any other projects, Collins can help that as well. And then, in between all of that variation, he's going to talk about right now. Go ahead, Colin. Thank you.
Yeah, yeah. Thank you, Sid. Absolutely. So this is just kind of a brief agenda of some of the topics that I'll cover today. What a self-directed IRA is, I'll kind of try to define that a little bit more. The restrictions, as well as advantages and type of assets that can be held in these accounts. I will explain more on how this works, the steps somebody would take if they wanted to pursue a self-directed IRA. Um, and then I'll also give a kind of like a case study, an example of how a deal is completed through using your IRA or 401k or whatever kind of retirement funds that you have. So first to kind of begin with the what is a self-directed IRA, and sort of build the foundation for the rest of the presentation. This is really not a distinct type of IRA account at all. It's not something that the IRS technically recognizes. It's not, you won't find the term self-directed in the tax code. It's just something we use more for marketing purposes to explain that through the IRA accounts that we offer, or that any self-directed custodian offers, you have the power to invest into the real estate market and really any kind of private equity. But real estate is obviously a big one. It's probably the majority of what we see in some form or another. But people that want to have a little bit more control or flexibility with their retirement accounts will move their funds into a self-directed plan, and there are many different types of IRAs and retirement plans that can technically be self-directed. So in short, it really just allows you to, that you can see this last sentence here that I'm reading, you can choose to invest in alternative assets such as real estate, commodities, private debt, or equity, and so much more. It really just gives you the ability to be in the driver's seat of your investments and not have to select between, maybe some mutual funds that Fidelity offers, or a bond portfolio at Vanguard, whatever it might be, right? So with that being said, and Sid, please feel free to stop me wherever it makes sense. But
I do want to ask a question. So on the
yeah.
previous slide, in summary, um, what you're actually trying to explain our investors is, um, it could be your employer account, it could be your own personal IRA that you've been maintaining as a self-employed person, or it
Mhm.
could be any of your investment that is being managed by those bigger shops like Fidelity and other people. All of those can be converted into a self-directed IRA. Is that correct?
Absolutely.
Uh,
Yeah. Yeah, anything that's considered to be, qualified retirement funds, or in a QRP, qualified retirement plan, is eligible usually. Though there are some restrictions depending on the plan that you're wanting to move. But yeah, IRAs, 401ks, 403bs, 457s, TSP
all can be
plans,
converted
there's all kinds of stuff out there. All are eligible for a self-directed IRA.
to direct IRA. Got it. And any of the um, profits from
Profit sharing
those
plans,
investment
yeah,
will go back to those custodian accounts. Got
absolutely.
it.
Yep.
So in other words, for investors who are new to this, if you are investing in or saving in pre-qualified, I want to use a simpler term. If you're trying to save pre-tax dollars through your employer or through any other form allowed by the IRS, you can use those funds and invest it as per your will with any private equity firm or any real estate projects that you like, and can control that. So all of that investment will be pre-taxed, and those returns will go back to those custodian account, right?
Yeah, yeah, they certainly can. I think there's plenty of different options when it comes to how the returns are handled. Even the tax benefits can differ from one account to another. So yeah, there are a lot of options, and I can talk to some of that
Yeah.
as well here, because there are different IRAs that are offered through these self-directed programs. The main two I would highlight here are the traditional and the Roth IRA, because I think they're very similar in most aspects other than the tax benefits, and it kind of paints a good example of the types of tax benefits that all retirement accounts have, 'cause there's really 2 different categories. One is the pre-tax, growth, Sid, which is what you referred to, where you can make contributions into a plan. A lot of times this is how your employer plans are set up, your 401k or your pension or profit sharing plan, whatever it might be, right? You put money into it before, your company, or maybe you pay taxes on it. And then those funds are allowed to grow tax deferred. And eventually, when you pull the money out, usually in your retirement years, once you're no longer working, then those funds get taxed, right? Whether it's the profit, the returns, or the original principal or contributions made into
Got
it.
it. Yeah. Yeah. And those are
Um,
all qualified as traditional IRA. Is that right?
yeah, exactly. Yeah, pre-tax IRAs, traditional IRAs, yeah.
Uh,
And so on the opposite end of the spectrum, what makes the Roth IRA different from the traditional IRA is that these funds grow. Technically, they grow tax deferred, but the advantage that the Roth IRA offers is when you are in retirement and you begin to, need these funds to live on because you're no longer earning an income from working, though those distributions can be potentially tax-free, completely tax-free. So with Roth IRAs, when you put money into it, it is already being taxed. Federal income, state income taxes are being taken out of that. And the reason somebody would do that is, you can put the same amount into it, you pay the taxes on it, but now those funds are allowed to grow potentially tax-free as opposed to just tax deferred. So that is the reason why um, there's a difference between the two and why some people would go with a Roth type of retirement account versus a traditional or pre-tax type of retirement account. Um,
How much you're allowed to go between those two?
Yeah, yeah, and sometimes other factors like your working years and tax rates or tax bracket. So there's a lot of factors to
Mm.
consider when it comes to choosing between the two. Um,
That's why it's important to talk to an expert because everybody's situation is individual, is unique. Obviously, we're not trying to generalize it, but go on. Let's go into SEP IRA. That's new to me.
yeah,
I,
yeah.
I think I
These
knew about
two
it, but I don't remember what was it.
These two are typically plans built for small businesses, maybe solo entrepreneurs, somebody that runs their own company.
Correct.
And these two as well are have different requirements and qualifications to be able to have one. They have each their own unique set of rules and advantages. So again, this just depends, sometimes on the individual which one makes more sense. But suffice to say, they are employer plans usually built out for small businesses, somebody that maybe is working for themselves, not for a company. So yeah, those are a few of the most popular types of self-directed accounts that are typically available. Um, and then as far as, yeah, income limits, required minimum distributions, the contribution limit, there are unique requirements to each one of these. So like Sid said, obviously talk to a CPA tax advisor, consult a professional before making a decision on which one is right for you. So with that being said, I wanted to highlight the difference between the type of assets or the investment selection that we offer with a self-directed account versus your more traditional investment selection, which looks like, public stocks, Apple, Google, Tesla, right? Any of those, as well as ETFs and mutual funds, index funds, pardon me, bonds and CDs, just to name a few of those. So these are usually the more common types of investments people think of when we talk about investing and saving for retirement. If you wanted to invest in a more traditional sense, with a more well-known institution, these are the kind of things that they would do for you, or that you would have options into investing yourself, I suppose. And so on the flip side of that, the kind of investments that we do here, are private equity and debt, lending options, real estate, of course, commodities and futures trading and hedge funds and all sorts of things. Some people invest maybe more passively into real estate. We have some who are invested directly into the market in their IRAs, own property, whereas others are in the lending business, and they may use their IRAs to do private lending to IRA account, or excuse me, to other real estate investors. So there's just a plethora of options, but yeah, real estate in general is something that is really, really big on our side of the marketplace.
Yeah. I just want to add a point here. What Collins is talking about here, in terms of how you can utilize your IRA if you want to, right? my advice has always been, if this is your only savings account that you're looking for retirement and you have no other saving, obviously be careful about what kind of changes, what kind of selections you want to make. But those are the traditional way, or these self-directed IRAs have been happening for a very long time. It's not the first time we're talking about it. I guess just in my lifetime experience, that's probably be the 50 plus times that I've heard people use IRAs as their investments. We take IRA investors, um, has a lot of paperwork, but we do it because we understand that this is important and very valuable for some of the investors to use IRA funds to invest. Um, but just to make a point here, like Colin's saying, there's hundreds of other ways to take those, to convert those IRAs or self-directed IRA and invest as you want to invest. Those strategies are not new, that we just talked about. They have been, I don't know, in action for last 50 years or so, or maybe 100 years. I don't even know how long would that be. And it's going to stay like that for nearable future. Uh, Once again, there's nothing new that we are talking about here. Is just a reminder for most of us, including myself, what are the options out there, and what is really that we should be taking smart decisions on. Calling back to
Yeah.
you.
Yeah, I said I think that's a really good point too. That these options and these strategies that you know people deploy are not new, but they're finally becoming more well known, right? So it's something that the ultra wealthy and high net worth individuals have taken advantage of for a long time, and it's you know something that we are taking the responsibility to make more people aware of, right? So with that, I'll keep pushing forward. First we'll kind of talk about the benefits of these IRA accounts. Some of this we've already touched on. And then I'll also go into the restrictions and you know the rule sets that follow these IRAs. So um, the benefits and advantages I break down into three different categories. So that would be the tax benefits, your diversification, and then the financial autonomy that these IRAs or these type of plans offer as well. Um, Tax benefits is one I think that I have touched on already, right? The difference between pre-tax and post-tax growth, whether that you know makes sense for you or which one is more valuable, I suppose, is going to be different for everybody. But I mean, tax benefits are the reason that we see a lot of real estate investors who use their retirement capital to invest into, you know, into real estate rather than just using personal funds is because of the tax benefits. They want to avoid any kind of capital gains, income taxes that they may have to pay on their investments, so they will do it through an IRA. It's a really common strategy that we see. The second one is the portfolio diversification, right? And this could be the you know anything from hedge funds to precious metal to real estate to you know you name it, right? There's a ton of different investment options on the alternative asset side, so it's really allowing you to diversify your portfolio and be a little bit less tied to the stock market and some of the volatility that that brings. So sometimes, especially for people that maybe are nearing or getting closer to retirement, um, real estate options and maybe more passive income options can be a very, very attractive strategy. There's the I think analogy that I always like to use when explaining this is that when you're invested in something that I saw, you know, managing people's portfolios in the public side, is that you can, you know, have the perfect breakdown of stocks to bonds, you know, equity to debt investments, and you know your portfolio is built out perfectly to match your risk tolerance in terms of like domestic versus international stocks and value versus growth and all these other factors, right? Which is very important, don't get me wrong, but you're still not getting funds out of the stock market where it can be invested a little bit more alternatively. So that is the example that I like to give. And then I'll just touch on this last one briefly, which is the financial autonomy piece, speaking to how investors something I already mentioned, but that how investors are able to really control what they do with their IRAs, and especially for folks that are experienced real estate investors or, have knowledge in this field or line of work. It can be very advantageous to invest in the things that you know best.
Awesome. No, I think this these are all strong points. My favorite one is tax benefits. You can defer those, and there's a famous saying: "You owe, and you die." Really,
Mhm,
that's what I'm implementing for myself. But again, these are again not the tax advisors. You have to consult your professionals. Portfolio diversification is extremely important. Um, I have a bunch of funds that have been invested into multifamily, which is my primary business. But I've got few. Me and my wife have some retirement funds that been invested into stock market, and the way we know things right now, we literally pulled back most of our portfolio in the stock market from mid-level or aggressive buckets to very, very conservative buckets. And
mhm.
that is one of the reason that if we could go buy some real estate that is distressed in market, we would definitely do that, right? Because we know where the market is. We all know in last few years we bought in the peak of the market, and I'm speaking to my investors who are still on the edge where to decide what they should be doing with their retirement accounts. I'd personally think, and again, what I've done, I can share with you guys, is that we've moved all of our funds from super aggressive or even from mid-level aggressive to a very conservative bucket. And if I have a way to go find distressed asset, distressed commercial real estate, I would do it all day long. So um, these are all really strong reasons why somebody should think self-directed IRAs. Colin.
Yeah. Yeah, very good points. And I agree the tax benefits is probably one of the most important here. I mean, it's the main reason why we have people that want to use their IRAs for real estate investments is because of the tax benefits. So yeah, certainly probably the most notable of the three. Um, Moving on from that, the IRA restrictions I think are very important to discuss as well because this sort of defines, who and how you can invest your IRA dollars, your retirement dollars. And so these are broken down into three different categories as well, and the first two are very tied into each other. So I'll review those first, a bit synonymously. So the people restrictions are basically it says the individuals who cannot enter into a transaction with the IRA. These are what we refer to as disqualified persons. So this would be yourself as the account holder, as well as your spouse, any lineal ascendants or descendants, and their spouses. It also includes any entities that those people are highly associated with is the way I typically put it, but, any that they own, operate, control, or are highly compensated by is really the IRS's definition of being involved.
Yeah.
Um, so the and
That means in summary, you cannot have your buddy in the same business to manage your IRA account and then do all of that. You have to have a custodian who's third party in an arm length distance.
Yep, absolutely. Absolutely. And so these restrictions or the transaction restrictions of what your IRA is not allowed to do with these disqualified parties is any kind of sale, exchange, or leasing of property, lending of money or extending credit, as well as furnishing goods, services, or facilities.
Yeah.
So to give an example of this, I could not own a vacation property that my parents are living in, right? Like that
Sure.
that's something as my lineal ascendants, my parents, grandparents, kids, etc. Anybody that falls into that disqualified person definition would be essentially um avoided from being able to use or benefit from my IRA activities. So, um, that's kind of a brief explanation, and then
Important point here, guys. Sorry, Con. And this came to me as a thought as well. Like, hey, can I use my IRA fund to go buy my life insurance? Good to know. We can't do that. So these are things that you cannot um, buy those things. Or so if you want to go buy collectibles, can you give a example of what collectibles?
yeah, yeah, that one, can be a lot more broad than life insurance policies, but collectibles will be like artwork or jewelry, vintage automobiles, playing cards, anything that's generally a little bit harder to put a price on, or maybe you have experts who
Appraisal, whichever way. If there's an appraisal is hard to get, that's when you cannot do that.
Yeah, because generally that's something that can lead to, tax loopholes and evasion and employing some of those strategies that the IRS would rather not have you use through retirement account. So that's,
Well, investors do not have to ever evade tax. There's so many ways to manage your tax smartly, defer it, and get to a point where you owe everything, but you never pay, because real estate is so powerful to put you in that position. So I just
that's
wanted to make
absolutely
sure that I'm saying this, because when we send out these recordings, those are the clips that go on social media. I just want it's a great point that you mentioned. I wanted to capture it. Thank you.
yeah. Yeah, absolutely. Um, okay, so moving on from the I would say the basis of these IRA accounts, and I'll discuss a little bit more now about how somebody can complete something like this, right? Why or how an investor would want to continue down this path. I always list the first part of this here is selecting a custodian, right? Somebody that you would want to do business with based on their customer service or fee schedule, maybe interactions or ratings or reviews, whatever it might be, right? That everybody is entitled to their own method of selecting a company that they want to work with. But I list a few things here that I think are important to consider, which is safeguarding of assets, how financially stable a custodian is, making sure that they do annual maintenance on your IRAs, processing IRS tax forms, 5498s, 1099Rs, whatever that might be, involved, as well as how they administer the account, and that can be left up to interpretation. But certainly the maintenance of the account is a very important factor in selecting a custodian. So these are kind of the quick, easy steps, we've laid out to making an investment through your IRA account. So the first one is first identifying what type of assets you're wanting to invest in, right? If that's single family or multifamily real estate, right? You decide, hey, I want to invest with Headway. I want to put some money into one of Sid's syndication deals. Perfect. Now you're going to then identify a custodian who can actually hold that asset for you and is willing to allow you to invest into the real estate market or whatever it might be. Once you've selected who that will be, you set up an account with them, would be the third step. Then you can move money to fund your IRA, right? So this could be rolling funds over from a 401k, transferring from another IRA account that you have elsewhere, any kind of pension plan, profit sharing plan, right? We discussed this a little bit already. Any type of retirement funds that you have available, and sometimes even non-retirement funds if you're wanting to make contributions into it, which I'll touch on in just a second. So fund the IRA by whatever means necessary or whatever means you want to, and then the last step would just be to make the investment, which we, as or whoever your custodian would be in this case, would walk you through.
Awesome.
Um, so I mentioned I would touch on this piece, which is this step four is funding your self-directed IRA, because there are a few different ways that we can do this. Transfers and rollovers are very similar. Uh, forms of moving funds, the main difference is the type of account that the funds are moving over from. So a transfer is what we refer to as a direct IRA to IRA movement, right? When I'm moving my IRA at Charles Schwab to my IRA at Inspira, that is considered a transfer. Whereas a rollover would be more like a 401k to an IRA, something that is a non-like account. Um, and the reason that I make a distinction here is because it's important to note that rollovers you may not always have the option to do. This was something I alluded to in the beginning of the presentation, but when you are still actively involved in an employer plan, a 401k, a TSP, 403, 403b account, whatever it is, they may restrict how much or at all your ability to take funds
Correct.
out of that account and roll them over. Once you have what they call a separation of service, you quit, retire, change jobs, change careers, whatever it could be, right? Or then you have the option to move over everything, but sometimes you may not be able to move out funds at all, or the company and the specifically the plan that you are a participant in will restrict how much you can move over. And so this is what we call in-service rollovers. While you're still actively involved with the plan or participating in the, 401k plan, for example, you may be able to take out a portion of it and move it over to an IRA account. But each plan is a little bit different. Usually they don't allow that until you're 60 years old. So, it's worth noting, but certainly you can always check with your plan sponsor or whoever is, the administrator for your retirement plan to figure out. And outside of that, contributions are the last thing that I'll make mention of here, which are funds typically coming from a taxable account. They're not existing retirement funds. Generally, it's money that you may have sitting in your checking account or savings account that you can contribute into an IRA plan or into a retirement
Correct.
plan.
Yeah.
So like people, most employees make 401k contributions every year. A lot of times your company has a matching, profit sharing plan or program that they will match some of your contributions and make employer contributions into that. So those are a couple of examples of how contributions are made into retirement accounts. And every type of, QRP or qualified retirement plan has a different contribution limit typically. So, depending on if it's a traditional or Roth IRA versus a 401k versus a SEP IRA, it's important, for you to know and consider what the contribution limit is. And that's where a CPA can certainly be able to help and answer some questions for you.
Awesome. I want to point out another thing. A lot of these IRAs and 401s are they are mostly applicable to people who are on W-2 jobs. But as you mentioned, SEP IRA, people who are self-employed,
Hmm.
they can also maintain those and manage those IRAs, or even offer it to the employees to be able to mm, contribute on those plans. So
Yeah,
by no
absolutely.
means this is not only for the job W-2 investors, but also if you are running your own practice, or you're a physician who's running your own practice, or you're a small business owner, or even a business owner like me, you can also create those SEP IRAs for yourself as well as for your employees. Is that correct, Collins?
Yeah, I mean, they're essentially small employer plans that are meant for small businesses or people that may be self-employed. You're absolutely right. And the contribution limits are much higher versus a regular or personal IRA plan because it's basically supplementing what, your normal W-2 worker would have as their 401k
Absolutely.
or their pension, whatever it might be. But yes, great point. Um, okay, and then the last thing here, Sid, and then I suppose we, can go into some more like summarized questions and happy to answer anything that the viewers have. But I'll give a fairly brief example here of how somebody might use their IRA funds to invest into a real estate deal. So In this case study that we'll go over, our subject is going to be Daniel. Now, Daniel is a 45-year-old director of sales for a consulting company, and actually was approached by a former colleague by the name of Ashley. She brought an opportunity to Daniel to invest in her real estate limited partnership. Right, she has a group that is investing into real estate multifamily, and brought this to Daniel with an opportunity for him to invest. He does not have any capital to invest personally, right? No, nothing in his savings account, taxable accounts, anything disposable or liquid that he could currently deploy into this multifamily investment to actually become a limited partner, or put some money to work there. So um actually suggests that a retirement account he may have from a previous employer could be a really good option for him to be able to invest into this deal. He does his due diligence, learns a little bit more, about the investment opportunity, about self-directed IRAs, even consults with his financial advisor, and then in the end, he decides to move forward. Daniel is going to take these funds, connect them through a custodian such as Inspire or any self-directed company, and he's going to open an account there, roll over the 200,000 that he'll then be able to invest into Ashley's partnership. So this is coming from an old 401k that he has. He moves 200,000 into that, invests it, and then from that point on, each year that profits, returns are made on the investment, all of that stuff funnels back into the IRA account. It is not subject to capital gains or income taxes, and that value is able to compound, right? The When we start talking about compounding interest,
Mm.
I've got, you know, my multifamily investment that made interest in year one, I can now use that interest, reinvest it to make more interest. So that's the principle of compounding interest, is when it just builds, it builds on itself over time, right? It's able to grow more quickly. Um, so Daniel is not taxed on this investment, as long as the funds remain in the IRA and for the life of the IRA until they're pulled out. He's not taxed on any of it. But at that point in time, when he does begin to take those funds out, he withdraws or makes distributions from his IRA account. That's
Don't
when.
forget, it also depends on what age, right? If he's drawing out after retirement, he may not have to pay as much taxes or not at all,
Yeah, yeah, very good point. I mean, they're technically still taxable, right? But yes, I mean,
depending on what.
a lot of times your tax bracket is a lot lower, taxable burden is much less. So that
I
that
just want to quickly insert a point here and then a follow up question to you, Collins. The point that I was trying to make is, like you were saying, if you're a real estate investor, Paris allows you so many ways to shelter and strategize your taxes that you never get into a scenario where you have to evade any taxes. I mean, obviously
Mhm.
that's a crime, so we don't want to do that. Nobody wants to do that, and that's one of the reasons why most of the wealthy people, or most of the people who wants to build wealth, they invest in real estate, mostly in commercial real estate, and they use these kind of self-directed IRAs accounts as their strategy and vehicle to even amplify their tax saving on the returns. When somebody invests, when you as an investor invest through your self-directed IRA or through your IRA or 401 account, again, consult your advisors before you do that. There's obviously some risk or more risk depending on what you pick and what you choose in where you're investing. But once you do that, especially in real estate, there's also something called um, cost segregation and accelerated depreciation. Right. So even if you go and draw those funds, even in your early ages before retirement, your depreciation can still impact and save you a lot more what you would have thought initially. Once again, these are unique situations. You have to talk to a CPA, and if you align those things properly, you may get to a point where you use your pre-tax dollars to save into real estate, get the capital gains on those real estate, and still do not pay tax when you draw it because you have depreciation carrying with you. Again, it doesn't apply to everybody. You have to check your own personal situation with your CPA before you do that. But I just wanted to throw a food of thought here is that it's possible that you use your pre-tax dollars, earn and never pay tax.
Yeah.
Back to you, Collins.
Yeah, yeah, thanks, Sid. Very good point. But that was about all that I had on this. I mean,
Awesome. Yeah.
the gains can continue to be reinvested is the only thing that I didn't call out here specifically.
One of the
Um,
questions one of the questions came, and you can definitely finish your thought here. Difference between self-directed IRA and self-directed 401. What is the legal problem? Is the legal changes there or process changes? Or what's the difference in these two?
you know, it's a very good question. For when I mean, the term self-directed, I would say, really makes no difference because it's again just more of a marketing term that could mean one thing versus another depending on who you're asking or who's actually
Mhm.
offering these plans. I would say in general, it's the same difference as like a 401k versus an IRA. Whether it's self-directed or not, 401ks are usually employer sponsored plans that somebody who works a W-2
Matches it
job.
up. Thank you.
Yeah, yeah, that they would have, whereas IRAs are more personal types of IRA accounts that usually anybody can set up, or at least anybody who qualifies. They're plans that are made for smaller scale, whereas 401ks
Bigger.
handle participants, sometimes in the thousands, obviously, but even more than that.
And is it easier one versus other to convert, or what's your take there?
Yeah, I mean, IRAs are certainly easier to move self-directed just because there are more custodians that offer them as opposed to like solo 401ks or
Solo 401k.
self-directed
Got it. Okay.
401ks.
Got it.
And then also, your 401k plan, you may not have the ability to roll it out into an IRA. Usually, you can move it over to another 401k, but then that either require some kind of planned termination or switching of custodians, which, just with
It could
401k
be
plans, because
what you're
they
saying. It
require
could be a
more
little bit
maintenance,
complicated.
it's
It could be when it
yeah.
comes to 401k because once you pull the money, move money out from 401k, it may get into you may have to qualify in both places, place where you are taking money out from and then where you're putting money back into, right? So, but it's doable, right? It's definitely doable.
Doable
I've
either
done that.
way, but
I've
yeah,
used
more
my 401.
complicated.
Yeah. Okay. Cool. One other question that I had, and thanks for thanks for doing that for us. A bunch of stuff is going to go to our social media or YouTube channel. Um, we do it on Wednesdays, and we only expect between 10 to 20 people because we have a database of 6,000 people that this goes out to.
Yeah.
So hopefully, what we're doing here is adding a lot of value. My question to you is, in your experience so far, what have you seen people doing and using the self-directed IRA? Is it more towards real estate, more towards stock market? I mean, would it make sense to take out the self-directed IRA and put it back into stock market because your self-directed IRA was managed by a market investor custodian? So,
Yeah.
but I could be wrong. I just want to ask you, what have you seen mostly people do?
Yeah, I mean, we see a lot of people who want to make a switch into real estate, and multifamily in particular is a big one. Really, any kind of syndicated investments are fairly popular. I mean, because they're passive investment opportunities to allow you, or enable you to get exposure to the real estate market,
Right,
right? And
right, right, right.
yeah, I think you and I
Have
both.
you ever seen somebody taking out self-directed, converting an IRA into a self-directed IRA or a rollover, and invest into CD account?
Yes, I mean it happens. It's I would say not as common, and we do have people who want to be invested in both because, to your point, it adds more diversification to your portfolio. But no, it's certainly not something we see every day.
Yeah. The reason I say that is, it's more like a gotcha question because you don't want to take out the IRA who's earning more and put it into a CD that locks your money and gives you 1% or less.
Yeah,
And that is one of the reasons why we at Headway we run an income fund, which actually is essentially a hard money loan that we give out to other sponsors. Towards the end of it, Camilla will share her screen and try to. If anybody interested, we pay out 8%, which is way superior than any other return out there, and we do take IRA or self-directed IRA funds in there. And if somebody's interested, they can obviously get in touch with you. Um,
Yeah.
can you share your contact information?
I was gonna say yeah, the last thing I'll put
Oh yeah,
this
please go ahead.
slide up here just to show
More numbers, we
everybody.
love it.
It's really just depicting the growth opportunity for this specific investment deal that we were discussing.
It's interesting. You're appreciating it with 8%, and we just talked about 8% return
It
on.
it can certainly be more, right? So, yeah, this
Yeah,
is kind of a conservative,
yeah.
approach, but just to give people an idea of how this money can grow, just
Can you tell us? Can you tell
in
us what are we looking at here? Give us a like a grade fifth grade explanation.
Sure. Yeah. So let's go back to our investment example,
Else,
right?
yeah,
Where Daniel invests 200,000. So to kind of illustrate how this money can grow, let's assume that Daniel is going to continue to have this $200,000 invested, and he's going to reinvest all of the interest, right? So that it compounds. We're going to also assume that he's earning 8% a year exactly, no more, no less, right? Daniel's initial investment of 200,000 turns into 300,000 just in 5 years, continuing to reinvest that money, letting it grow. 430,000 in 10 years from the initial investment date, and then in 15 years by the time he retires, it's up to $630,000. And that's just the power of these IRAs, not having to pay taxes, being able to reinvest 100% of the profits that you're earning. Now, imagine if this 200,000 was done through a Roth IRA, and now you've got $630,000 of tax-free retirement money that you can pull from for the rest of your life. So,
yeah.
that's
With the comparison of uh, if this was done through cash,
yeah.
a taxable amount. But it would be interesting. I know that you don't have that slide right over here, but it would be
Yeah, I
interesting.
don't have those details in front of me, but I mean, obviously, it's a lot more impacted when you're having to
Yeah,
pay, 20, 30% in taxes every year.
yeah,
That's a whole lot of the return that does not get to be reinvested.
yeah, yeah. So you can easily cut down every year, or when you draw that amount, you can easily cut down 30% out of it.
Yeah,
Anywhere between 25 to 40%, depending on your situation. Right.
exactly. Exactly. Yeah.
Mm.
Yes, but that's hopefully just an example that helps people understand a little bit how these funds can grow and why it's more advantageous to be able to avoid the tax
Very
rather
cool.
than dealing with it. So yeah, here's my contact information set. I've got our website up here and my information right above that.
Do you guys have office in Houston?
We do not. Our only office is up in Chicago. But, yeah, I mean, I'm down in Houston personally. A lot of our team is kinda spread out across the country, so
Very cool. Very cool. Definitely, I will definitely be in touch with you. I think we've got a few things that we need to uh, streamline. Truly appreciate your time here, Collins. We do have several other questions. I'm gonna be 5 minutes to wrap up.
sure.
One of the questions that came to us on, hang on a second, let me see. I mean, are you ready to share your screen? And because there was a question about
Yep.
how does Headway help with the income fund? Can you share our audience the screen where how they can connect with us and the phone number, email, or QR code, and what is it about?
Yes, you can see my screen. Give me a second.
You can unshare it and go back to the slide and then do it again.
Yes. Give me a second. Okay, you can see it now.
Awesome. So I just want to quickly give our audience what is this about, and if you're interested, we can definitely talk more. Kamala is our investor relation associate. She can be available on the phone calls. Um, Headway Income Fund, we launched in 2023, but we've been it's been established in since 2020. We work with an operator, and those funds gets deployed as a loan, as a hard money loan for for commercial or residential real estate. That's a first lien position, and we pay out between 6% to 8%, or even more depending on how much you're investing. Minimum is 25. If you cross 100,000, the returns becomes 8%. One thing that's not yes, there's a compounding option here. Like Collins and his solution, what you can do is you can really leave that money IRA or self-directed IRA money or self-directed 401 money, and by be able to compound it every year over year and not to draw it. So that gives out 8% return, and it's actually highly liquid, meaning within a 90-day notice, you can take back your funds. We said 90 days, but we historically we have never taken 90 days. We liquidate the funds within 30 days to 45 days. But again, 90 days is a standard timeline that we tell our investors. But like, can you share if somebody wants to get in touch, how they can get in touch with us?
Yes.
There's
Let me
a
go ahead and share
comment.
the information.
Kamala, you sharing a screen?
Yes. Can you see my screen now?
It's coming up. Good. So this is for 506C. Somebody even asked, how many years does it require to reestablish your accreditation letter? So if, any idea how many years it takes? If you have a CPA accreditation letter, um, how many years is good for?
It's a good question. I'm really not sure the answer to that. I was under the
I
impression
think it's
that
2 years because, yeah, I think
oh
it's 2 years
okay.
because I recently had to refresh it. So, but I wasn't sure, so that's why I thought
Yeah.
maybe we can ask the audience. So it's a 506C offering, and Collins here, this is open. This fund is financially audited. If you have clients that looking to do something like this, happy to give you more details on it. It's a financially audited fund that puts out hard money loan. If you are interested, people who are on the call, there's a QR code, or you can go to our website, or you can connect us with the phone number. Kamala, can you share the phone number? Yep, it's 281-559-7061. And if you want these slides, text us, and we will request Collins to share his slides if possible.
Yeah.
But that being said, we're on our hours mark. Um, Collins, any last comments for our for our viewers and listeners?
No, I would just say, please let me know if anybody has questions. I'm more than happy to have a conversation to help people determine what is the
Yeah.
best path for them moving forward.
And
And
if you can give if you give us your contact information, we'll share with our audience as well.
yeah,
Like I said, we are close to about 7,000 people, just 6,000 and change in our database, and, um, and it's growing. It's growing pretty much every week. These educational webinars, podcasts really help. Uh, you know, our job is to add value 99% of the time, and that gives us the most confidence with our investors. So thanks again for doing that. Um, we will upload this probably within 2 weeks or less, and if you have any questions, we'll let you know.
okay,
Awesome.
yeah, sounds great. Thank you guys so much for giving me the opportunity and happy to be here.
Yep. Awesome. Thank you.
Yep.
Let me stop that recording.